Hello, Culture Matters podcast. We're back again with another value investor series with co-host Aleck Arena. Before we introduce our show, here's a quote just for this podcast.
Thanks for the introduction, Jay. And the quote is, "The intelligent investor is a realist who sells to optimists and buys from pessimists." Ben Graham, the intelligent investor.
Sells to optimists, buys from pessimists. What does that mean?
Uh, Intelligent investor always loves to sell when the outlook's stock is priced to perfection and some. So that's the optimists. They're selling to the optimists there because they're saying the stock's just going to keep on going. The business is just going to keep on getting better and better. Um, and the pessimist, they're buying from the pessimist when the stock may be beaten down for no reason. They think it presents value, and yeah, they're going to dig in and buy some shares at a cheap price, at a discount to what they believe the intrinsic value is.
What are some things as a value investor that you would do to be able to decipher if it's a time of optimism or pessimism as it relates to a stock?
Uh, Stock specific, it's kind of it's a hard one. If it's a certain stock, maybe it's going to be pessimistic. Usually, if the general market's down, that's probably when you want to buy. If the general market's down and the stock's down, you probably want to buy the stock because it would be selling below its intrinsic value because the liquidity would have been drawn out of the system. If if the stock's cheap and the market's not down, it's probably cheap for a reason. It's probably cheap because some key personnel in the business has just walked out, or there could be a various number of reasons. And I don't know anyone's personal financial circumstances, but from my experience, it's always if a stock's just getting cheaper and cheaper for no real reason, they might be catching a falling knife. Like maybe they've missed something in their earnings, or maybe they've not realized the risk that's involved in the business, or maybe they haven't realized how the commodity price going up will affect next year's profitability, because the market is always forward looking. So it's it's great to look at what's happened 12 months ago, but you're trying to work out what's going to happen next year, the year after that, and have a rough estimate. Really, like you can't estimate too far out, but you have the investor effectively wants to think that the future cash flows are more than the present cash flows if they're doing value investing with the Charlie Munger approach. Do you understand what I mean by that, Jay? Like the Charlie Munger approach to value investing, not the traditional Ben Graham approach.
Yeah, how would you distinguish between the two main, if there's two main
The Ben Graham approach
principles?
is reasonably dead because they Ben Graham tries to buy, well, he tried to buy the cheapest possible thing he could find, relative to its net asset value. If it was really, really cheap, like it's producing a lot of free cash flow, it would just buy things really, really cheap. So it'd be like going to the supermarket, knowing the lettuce on the shelf's worth $2 and it's selling for $1. So Ben Graham effectively walked in, bought the lettuce, and then walks out of the shopping center and finds someone that would want to buy it for $2. That's what Ben Graham did. Where Charlie Munger goes and looks at the quality of the business, judges the return on capital, um, loves for there to be like a tailwind, like the classic kind of Berkshire Hathaway investments, where I feel like Charlie's hand was he was showing the way for Warren is Gillette and Coca-Cola because it was like big tailwinds behind them. You could kind of back then you could see that people were going to drink more and more Coca-Cola as the years went on because it was a staple of the American consumer and the world consumer. It was an extremely well-known brand. People knew exactly what they were going to get, and it's kind of semi-addictive. So that's always great. And Gillette, the thesis about Gillette was that there's more people are going to shave today than they are tomorrow. And they thought Gillette starting a brand that would have pricing power, and they refer to it as the razor and blade model. So it's quite cheap to actually buy the shaver, but to buy the shaver heads are more expensive. And yeah, back then the culture was that everyone needed to be clean shaved and it looked more professional for you. So if they were extrapolating that forward and going as long as they don't have major hiccups in the business should produce more free cash flow in 15 years from now than it is today. I think Gillette was a really, really easy one because of those reasons, because they had pricing power over the blades and they did a good, like you buy a Gillette shaver, you know you're always going to do a good quality job. Um, yeah.
When you're looking through and you're filtering potential opportunities to invest, what are some early red flags that you may say, oh, I'm not going to go deeper in my research, like things that just stick out? Right? Because
Uh,
if you have a pile of things to look through, I'm thinking a
yeah.
percentage, you're very quickly going to say, I'm not going to, it's like reading a books, right? I look at open up the book, I look at the table of contents. Oh, I don't want to read this book. Or I open up the book, I look at the table. Oh, that looks interesting. Let me go to this chapter. Oh, maybe that's interesting. Let me go and do another chapter. How would you say, oh, so the question is what sticks out that you're not going to pursue further research, some variables that stick out, right?
If
Like
I
if,
don't, well, if if the business is bleeding heaps of cash, like the business is always losing a lot of money, and I don't see a way for it to get to profitability in a really quick period of time, I'm not going to want to do much more research on the stock. If the balance sheet is extremely stretched and I'm not getting compensated as the investor for that, I'm going to not do much more research on the stock because that's a serious risk. Um, it's a risk for the deterioration of the business in the short term and the long term because if they're trying to keep up with competitors, they're going to need to keep spending money on R&D, and obviously they want to be the best product in the market for whatever business they're in. And in the short term, obviously, if you've got way too much debt on your balance sheet, you're probably not going to go broke if you're a listed company. You're probably going to go back to shareholders and raise money, raise capital, issue more shares. If you issue more shares, the shareholders own less because they've just added more cake to the. I don't know how to
mm,
explain it. It's like saying there was one cake to eat from that was all the initial shareholders, and then they've brought in a secondary cake. So now the first cake's worth less. I feel like that's a terrible way of explaining dilution, but I tried to explain diluting
or is it
shareholders
more
that
people come in so that there's less cake for everyone?
yeah, Jay's a genius.
Well, yeah, no, you helped me with. I never even thought of it that way. It's easier, right,
Yeah,
to stand on your shoulders.
yeah. Um, and then if management have sold down a bunch of stock, it's not a red flag, but it's an orange flag.
Okay, okay.
So because management usually they buy for one reason and one reason only. They know more about the company than the outside investor does. It's a really good sign if they're spending their own hard-earned money, and especially if they're spending big chunks of their wages buying stock. It's a great sign.
Why?
Um, because they think the business's outlook is good and they probably think earnings is going to improve. They can be wrong. The investor, if not, it's not the case all the time, but a fair proportion of the time, usually, if the management team is buying the stock, it's a really good sign because maybe it's not the next year or the next 2 years, but they really must believe in the business.
Could it ever be a negative sign?
If the management's buying the stock, if the management, I know if
Like if it could become too promotional at some level?
yes, it can become too promotional at some level, but I just have to be careful of what I'm saying here because I found management teams can go buy a very insignificant amount of stock to try to boost the share price to be a show of confidence. So if the CEO is earning $500,000 and he's buying $2,000 worth of shares every quarter or $1,000 worth of shares every quarter, it's a nothing burger in my opinion. Maybe he's his personal expenses are way too high. I don't know exactly. You can never tell that stuff. So maybe he actually does like the stock, or if he's doing it for a long period of years, he's probably just promotional. But in saying that, I know people that are on boards of companies and they'll buy every quarter at a random price, but it's a more significant amount of money. It's a much more
Could could
significant
could a
amount of
could a public company in theory be more loose with debt because there's so many equity shareholders that could come in and outside of? Is that one of the advantages that could be taken
Yes, it is, but I
far,
wouldn't
or
want them to be too fancy around that because when you're diluting shareholders, it's really bad for the shareholders because then they own less of the company. Like to get capital, you've usually worked hard for that capital, then you're investing it somewhere else, and then they're making your shares worth less because they're issuing shares, they're effectively pulling shares out of the backside and issuing them to random investors to raise more money for their kitty. So I don't I don't like when companies raise capital. If a company's raising capital, you'd want it to be very earnings accretive. There needs to be a seriously good reason for a company to be raising capital.
what are some good reasons that you've seen in your experience? Or
I haven't seen many good reasons to raise capital, Jay, if I'm being honest. If the company's going to go broke, I'd prefer them to raise capital than to go broke. Um, that's yeah, if it's a really accretive acquisition and they know it's going to be a really good acquisition, but the only problem with this is that in the share market, 33% of the time the acquisition is accretive. 33% of the
oh,
time the acquisition isn't accretive, so you don't do anything. And 33% of the time it's not accretive, so they've just lost shareholders' money. So yeah, it's really
wait,
mathematically the odds aren't on your side there.
so 33% of the time it works and the other 66, no?
The other, so the other 66, I would say it doesn't work because it either adds no value or deteriorates. Like it's bad for value for shareholders. They're not creating value for shareholders 1/3 of the time.
Hmm.
So 1/3 of the time they are creating value for shareholders. 1/3 of the time they're not, and 1/3 of the time they are. Did I,
It's kind of
did
like
I stuff
mixed.
that? I might have
No,
stuffed
I
it up,
think you
but
had it.
yeah,
Or it's kind
effectively
of neutral.
it's a little, I would say it's a little worse than neutral because I would say the neutral outcome's bad because then the CEO is running a bigger business and he's going to want more compensation. The bad outcome's extremely bad, and the good outcome is okay. Like if they create more value for shareholders, that's always good. I wouldn't complain, but they would need a very, very good reason to do that.
Hmm.
One of my companies I owned the portfolio recently did it, Visart. They raised, I think, $38 million and they deployed 24 from memory. This was probably about 6 to 9 months ago now. And they raised the money on about 15 times earnings. So they raised it on uh, a normal kind of public market multiple. And they bought a business on, I think it was, I can't remember, but I think it was like 5 to 6. So times earnings. So it was accretive for them, but it wouldn't be accretive for a lot of other businesses.
What was Ben Graham's, I guess, message, epiphany, philosophy at the time? Why was that? And was it unique? Why was it relevant for the time?
It was relevant for the time because no one really was in financial markets. They weren't covered really well at all. And it was the easiest, safest way to make money. So that's kind of why it was relevant at the time. Also, if markets are inefficient, it's people's jobs to work out. It's the investor's job to work out where the inefficiencies are so the investor can make money. So after Ben Graham obviously writing the book and explaining his philosophy, the market catches on to what Ben Graham was doing and it becomes more efficient over time. As it becomes more efficient over time, there's less opportunity for investors to do what he did.
And what was his original thought?
We touched on that earlier in the podcast, and it was just to buy really, really cheap businesses. It was just to buy businesses that are really, really cheap. So
And in his time, you could tell that by reading the financials.
yeah, you can
And
tell that now by reading the financials, but the problem is the market makers will pick up on that stuff straight away. So if the share gets at a bit of a discount to net asset value or cash, um, the brokerage houses are going to bid it up. Like if you can understand what I'm saying, they're going to bid it to the price where it's discounted enough where there's still a slight margin of safety for them, but not for any other investors. But
mm,
if there's a steep discount in today's market, what's probably happening is that the market's discounting because they think management's incompetent or they see a big risk around the corner. Maybe if it's an insurance business and the share price now sells for slightly negative net asset value, what's probably happened is there's been a massive storm in Florida or something like that, and they've had to pay out money to their clients. Because obviously your asset value, how you calculate asset value, you go back to the last annual report and it shows you how much money is on the company's balance sheet, how much money the company made. And if you think the company's on a similar or same run rate, this is a bit risky, but you can add, if 6 months has passed since the last annual report, you can add that 6 months worth of cash onto the balance sheet and go, the company would have X, Y, and Z amount of cash now, not the original starting balance.
So the market can be right about a company and a price, but things can change.
Certainly, yeah.
How important is it to follow companies or like what? So you do a bunch of, a tremendous amount of research.
If you don't follow companies, you should just buy ETFs, in my opinion.
Why? Why? Well, I guess we should define what's following companies.
If
What
you
is that?
don't read their financial statements and go to quarterly earnings calls and do all that stuff, it's a mugs game, and you're probably just you're not punting. Sorry, you're punting. You're not investing. You're gambling.
Why? Why?
Because you're not the informed investor. If you're going to be an investor, you want to have an edge. You want to know something the market doesn't know. That's how you get. That's how you have good performance.
It doesn't know, or before it finds out.
Yeah, before it finds, you want to you want to you want to have an edge over the market. So you want to know something before the market knows it. I'm not advocating for insider trading there or anything like that. What I'm advocating for is just doing your research. And sometimes the market, if it's a really small company, they can miss something in the financials. They don't communicate with management as well as you do. They might not see the vision. They might not trust management for some reason. There's all the maybe one of the old co-founders has died and a bunch of their stocks getting sold on market from like the family estate, if you get what I mean. That happens sometimes, and that keeps a cap in the share price. And if you're an in the know investor, you can obviously buy those shares at a discount because maybe there's a large chunk. So you buy them at a discount, and after people have finished buying, the share price will re-rate to the correct level where it should be.
I'd be curious of how many people that are in the market professionally are actually at any given time thinking for themselves.
Well, Warren Buffett thinks it's low, but I can't touch on that.
Like, why would he think it's low?
He thinks that most of the people on Wall Street, or most fund managers, if they're made down the street, thinks it's a good idea, they'll also think it's a good idea.
Whispers kind of travel, like compounding in compounding works in all ways, not just a penny doubled for 30 days
yeah.
is 5+ million, but
Obviously, it takes
a
time.
whisper doubled.
It takes time for fund managers to do their own research, and best way to save time is to copy someone else's idea. But if you copy someone else's idea, it's extremely dangerous because it means you generally don't know the stock as well as you should. So if something happens, if an announcement happens, you can be shaken out if it's good, or you obviously don't understand the management team. You don't really fully understand the vision. I'm not one for taking another person's ideas. Obviously, if someone lets me know about a good idea, I'll open, I'll do research on it myself. And that will take
I would
quite a
want to
while.
know how many people are even pursuing it in a professional sense. How many people are actually are at any given time are thinking, what is the thinking process as it relates to an value investing or an intentional investment process?
Can you repeat the question again? Sorry.
Let's say, I don't know, that if there's 100,000 people paying its
Supposedly being
supposedly paying attention,
yeah.
what percentage of the 100,000 are, let's say, and now to get to understand it, they are, we'd have to know what paying attention actually means. So like if we could unpack, is it Warren Buffett's daily schedule, like the things that he's doing, the things that he's not
I would
doing?
say that's paying attention, being like Warren Buffett, not being like
Right. So the question becomes, let's
reading the
say if there's
macro
100,000 people in the business, are there 1,000 people that are modeling
I
some type of model, or
I
right?
don't
Like,
really want to speak to
I
that
don't
because I can't.
how many people, and then my next question to you though is maybe whether we can unpack this over time, but like based on how many available securities there are at any given time,
Mhm.
depending on how many people are thinking and are paying attention, like have original thoughts, there might be too many stocks for anyone, for all of them cumulatively to have figured out. I
Yeah,
don't know how many stocks there are, but
that
how
creates
many
opportunity.
stocks are there?
I don't know how many stocks there
50,000. Well,
is.
I guess I'm looking at the
I
US.
know
You're looking at
in
Australia.
Australia there's 4,000, I think 4,200
Of
listed
all the
companies.
different sizes.
Yep.
And of course, Australia is a smaller country
Country.
than the
Yep.
US. How many professionals in finance could there even be? And then of those, how many could even be thinking? And
To answer your question,
I don't know if we have answers for this, but
Warren Buffett effectively thinks that no one really does the work. That's
yeah, like
his.
what
That's
is the
his opinion.
work? It seemed like at the 2025 shareholder meeting, some of what the work was when Greg Abel and Warren were talking about this 3,000 page book that Warren was reading of Japanese stocks that he couldn't see the print anymore. It's like,
Yeah.
did he step down because he can't see anymore? Literally see with
No,
his eyes?
no. I don't think that's the case. So, uh, he still obviously adds value if he's doing those types of things. Yeah. Uh, I don't have much to add there. I know I can't comment that much on what
How would you say you come up with original ideas then? Or what would that process look like for you?
original ideas is you've come across a stock somehow. Um, it might be flicking through the ASX. One of your former companies might have been bought by that company. So like I go to like the stock exchange, not to the building, but to the website. And in Australia, if you don't type in a ticker code, like if you don't type in a stock code, it will come up with all the like announcements that day on all the companies that are listed. And you can flick through there and just find stuff organically. You can screen for like there's like software programs that you can use that screen for like shares that are under a $200 million market cap. You can screen for shares in a certain industry. Then
Hmm.
yeah, you need to go back, read the financial reports. And don't just read 1 year, you got to read multiple years, read the quarterly updates.
And then you have to stay in touch.
Yeah,
It's like if we have a sales process for a business, it's like, who are our customers? Why? Where are they? Am I reaching out to them? How am I following up with them? How many convert? Of those that convert, how many fall into duds? How
yeah.
many work out? It's like,
My shares are
but you're
like
doing that in a
your,
stocks standpoint.
yeah, they're like your future customers. So maybe you had a meeting with someone 5 years ago and you haven't got them on board, but we've kept up with them. And then 5 years later, you've grown with them. You understand their business, more than you did 5 years ago. And then you jump in. It's rare that I'll learn about a stock and jump in straight away. Um,
So it's like
I can't, I
screen
won't,
and
I
you're
won't
narrowing
say,
it down.
yeah, I won't say I'll never do it. If there's a really, really good opportunity, I might jump in straight away, but it's not the mainstream way how I invest. Yeah, I can't comment about the future because I don't know what the opportunity set is.
But it's staying in touch
Yeah.
and following back up. Because you're saying there are things on the macro side that can lower, you said earlier in the conversation, something if the stocks can go down because there's external events that make good things
Like tariffs. They just say like, yeah.
appear bad,
Mm.
or right, appear like they're going like a tariff or something external that's
Yeah. So
leading the valuation to go
with
down.
when Trump announced the tariffs on Liberation Day, um, some of the stocks that went down were affected by tariffs and they were priced accordingly, plus some. Some of them were priced accordingly, And then some of the stocks just went down because there was being a bunch of money ripped out of the system because everyone was scared because people were pricing in a recession because they're thinking forward and going, well, if Trump goes ahead with this, the US consumer is going to come under more pressure because tariffs will be inflationary to start with because it pumps the, because if you're using globalization, which every Western country is, your goods, most of them get produced offshore because you're exploiting a third world country's cheap labor effectively. So if you import stuff from China and then he's effectively taxing the US consumer on buying goods and services out of China. And then Jay Doran has to pay more money for an Amazon box that he's some goods he's got from Amazon that are made in China. And then Jay's going to have less money to spend on ice cream and go to restaurants and all that, which is in turn bad for the US economy. So the stock market, I think, started to price a recession. But I think that was just the flow of the weight of money of everyone realizing that it's bad, that I think there was an overreaction there. And then there would naturally be a reaction from reserve banks around the world. If the US consumer is coming under a lot of pressure, you would think the US Federal Reserve would decrease rates. But if that were to happen, they would need to see the backdated economic data. So the Fed will never move before the Fed, they always want proof. They can't, it'd be irresponsible for them to move before they knew the US consumer was under pressure. Then once they know that, they will know how much and they can maybe drop rates back. They have a lever to pull there. If they need to pull the lever or not, I don't know. We'll know 6 months after the tariffs are in place. So you guys might come across a hard time and the stock market might have been correct, but no one knows what the stock market's going to be in 6 months' time. You don't know. We can have another AI could advance, it can increase the productivity, it can help it could help the productivity in America, which could boost corporate earnings. No one really knows at the end of the day. Yeah, if I was to take a 5 year view on the economy, I'd be pretty happy with where we are today and where I think we're going to go. And I'm talking about just not the US economy, I'm talking about the global economy.
Hmm. I wrote this down from like this masterclass on value. So make a list. Maybe if it's 1,000 opportunities, I might research more heavily much smaller percentage. So let's just say it's
Yep.
100, just to play loosely on this.
Yep.
10 of those, I might allocate capital after further research. 90, I might just do nothing, but I'm gonna pay attention. So I need to wait and follow up and also pay attention to the ones I did allocate capital. And
Yep.
there's got to be behaviors that we can unpack over time that someone like a Warren, someone like a Charlie, others like a Peter Lynch or an Aleck Arena or any of those that we've had on the show, that there's common denominators of behaviors or habits that they represent that the 96% or the 99% in financial services that are not necessarily thinking for themselves are not like representing in their daily rituals. But so I have make a list, research, allocate or not out. It's like Shakespeare. To allocate
Okay.
or not allocate, that is the question.
Yep.
Follow up with the ones that aren't, and then
Yep.
pay attention to the ones that are, and stay in the game. Now that it sounds like, and this is the closing question, like a tremendous amount of work.
Yeah, that's what we
So
get.
like people listening, they're not doing this on the side after they do soccer practice with their kids and their full-time job. So if you could speak to that.
Yeah, it is a tremendous amount of work, but obviously at the end of the day, I'm trying to outperform the market, trying to create value for my own shareholders in Australia, and obviously myself because I'm a shareholder. Yeah, as I said, I wouldn't recommend going out and randomly buying stocks. I think that's risky, and I really think that's gambling. I think you need to be the educated investor, not the uneducated investor. If that means you need to sell all your stocks and go away and read some books and educate yourself on how to read financial reports,
Hmm.
I'd recommend a listener to do that. And then from there, if the share market doesn't need to be for everyone. It's a great tool and a great way to make money, but I think if you were to buy an index over time. So if you were to buy the 500 biggest companies in America, if those companies' earnings grew over time, which it probably would if American GDP went up, if the American economy became better and better, we expect the stock market to perform well because that's American business. Um, so yeah, you can own that over a long period of time, and I would assume that would increase in value.
But if we were to, there's just food for thought, compare, and seems like the golden
Passive
chalice.
investing to
Yeah, like passive investing versus people that are listening to go find, research and try to partner
yeah.
with the right.
So in passive investing, I think you'd probably need like 10 minutes every month.
Hmm.
And then in active investing, you'd probably need the whole month. Maybe you want to do a split. So maybe you want to own a few stocks that you think you understand well because you're in that industry. That's a great way how to make money in the stock market. If you have an insight that an analyst in the industry doesn't, because you work in the industry and you know the good competitors and you know the bad businesses, the ones to stay away from. Yeah, you've got an edge over a financial analyst
Oh,
sitting.
quick question on this. It's what's like the difference between 10% a year for 30 years and 12% a year for 30 years? Like,
I don't know exactly, but it would be a quantum leap. It would be the difference of multi-million dollars. Like it would be, I don't know exactly how much your starting investment is, but you'd be talking, yeah, the difference between 10 and 12% is huge.
why so big?
Because initially you've done 10% and then you're compounding the 10 on the 10. And if you've initially done 12 and you're compounding the 12 on the 12, over time, you're not going to notice it probably over a 5 year period, but over a 10, 15, 20 year period, 30 years, it's going to be a massive, it's like going to be a quantum leap.
Do you think is that why the uber wealthy chase this? That they chase 12 versus 10 or 13 versus 10 or
Yeah, that is why they chase it because it's a smarter allocation of time to them. If they can work on, because they've got so much more money to start with, if they can work on getting those few extra percentage points, it's it's a great use of their time.
I
If
was also
you're
thinking about
if
this.
you're really, really poor, you're probably best off working your
uh,
way up through the corporate ladder or starting your own business or doing whatever you want to do and just accepting the
I was thinking about this the other
random
day.
amounts you get,
If it's
which
like a
totals to about
generational
8%.
thing, or
Yep.
like the more family members or the more generations, the higher return is needed because there's more humans. Like if I'm first gen and I have two kids
Uh-huh.
versus I'm sixth gen and there's like 180 people in the family, there's so many more mouths to fill, mouths to feed.
Yeah.
So if like rate of return helps hedge the compounding of the humans being, so it's like a tension. I don't know, it's
I
random.
understand what you're saying. Yeah. But obviously inflation will eat away at the person's purchasing power. Um, and that will suck for the entrepreneur. But also, I think staying alive is really, really important. I understand, like, I'm not saying it's like a
Yeah,
personal perspective, but I'm saying financially staying alive
not taking
and
too much
being
risk.
in the game for as long as you can, you can still get the compounds. Because if you accidentally try to go too aggressive, you blow up most of your capital, and then it's so far to get you back to your point which you previously were in. So I think if you stay alive, I think the average person will see about 4 to 5 great opportunities to invest throughout their lifetime. And if they do that, they'll get above market returns. I would say they'll get above 8%. They could probably get above 10%. Um, I obviously can't guarantee you. We're doing this podcast for a bit of fun. I don't
Yeah,
know anyone's circumstances, and I don't know when the next great recession is going to be or the next global financial crisis or anything like that. But throughout history, if you live 80 years, you see about 4 great opportunities to buy shares. I've already probably seen one, maybe two.
wow.
So maybe I've only got two left. But yeah, yeah.
Well, if you're listening to this, understand that in the time of Berkshire, we learned this at the 2025 meeting, that the S&P returned 39,000% since Berkshire's inception in 65 when it became Buffett's responsibility. And Berkshire comparatively was about 5.5 million%. So clearly there's something about compounding, value investing, being one of those percentage of people that are paying attention, figuring out how to crack the code.
Yeah.
And today we get to have a co-host here, Aleck Arena, who's cracking the code, opening the safe and taking what's inside of it, as we, metaphorically. Thanks for coming back. I'm excited to
Yeah.
keep unpacking these episodes and some of the new exciting guests that we have on the show. Any last words?
No, I think you just with the Berkshire thing. I think you said Berkshire twice. So I think Jay meant to say the S&P 500 was
Oh shoot. Yeah,
what was it? 50,000. What was it, Jay?
Oh yeah. S&P 500 was 39,000%
Yep.
return since like basically Buffett took over
Over
Berkshire
Berkshire,
in
and Berkshire
65.
was what 50.
5,500,000 roughly. Crazy.
Yeah, yeah, that's insane. I saw a stat saying that if Berkshire was to lose 99% of its value, it would still be beating the S&P 500 since Warren's taking the reins there. Yeah, just what I had to add. I've got one last thing to add because we were talking about being defensive. What I meant by that is sometimes you need to be defensive to play an offensive game. When the market's overvalued, I wouldn't be putting heaps of risk on the table. I'd be waiting for the next opportunity. So in cricket, we would just, yeah, in a cricket game, would be blocking the ball, keeping it away from your stumps. If you get bowled over, you're out and you have to walk and you have to walk and you can't keep playing the game. If you keep defending for those few hard balls and you get past them, there'll be a better opportunity and you can probably hit the ball for a six or you can hit it out of the park in baseball terminology. So yeah, just knowing when to wait and knowing when to go. Investing such a great game because, as Warren said, you don't get struck out. It's not like baseball. So in baseball, you can't just sit there and not swing. You have to swing because after a few strikes, you're going to be out. And investing, you can just keep the bat on your shoulder and swing when you have the perfect pitch.
If you're listening to this, go check out our other episodes at Aleck Arena of Arena Securities. Share this with a friend that wants to learn about investing and value investing. And we will see you next time on the Culture Matters podcast. Thanks, brother.